Joining us right now to talk more about this week's big Fed meeting. Michelle Meyer is here, head of U.S. economics of Bank of America Merrill Lynch. Also, Nathan Sheets, chief economist at PGIM Fixed Income. Let me ask you both, given what took place over the weekend, is that going to weigh at all on what we think the Fed's going to be thinking?
Well, I'm sure it's going to be a discussion around the table. I don't think it's going to influence the statement or the communication. I'm sure Fed Chair Powell will be asked about it at the press conference. And he'll likely talk about it as just one more risk for the Fed to monitor. Obviously, the U.S. consumer is vulnerable and sensitive to higher gasoline prices. So if we were to see oil prices spike and gasoline prices to go up, that can create some challenges. It's another factor that could be a concern for the health of the global economy.
Well, that's what I was going to ask. And does it change the dynamic in terms of what you think is going to happen between the U.S. and China? Does it give China some pause? Maybe we have a better chance of getting a deal. I mean, I don't know how much you start doing that math and that equation. Nathan?
So I think the bottom line on this is we don't know how long it will last and what the full dimensions will be, et cetera, but it amps up further uncertainty in the global economy. And that, quite frankly, is the last thing that we need now. And I think it will, at least on the margin, shift the calculus for President Trump and President Xi as they're thinking about incentives to negotiate. Okay. My instinct would be on the margin. Maybe it makes, if it's a sustained shock to the oil sector, on the margin might make a deal a little bit more likely.
Okay,
I'm
so
not sure it's
if
determinative.
you're Jay Powell and you're sitting there on a Sunday yesterday thinking, okay, now what? What's the new? Is this changed anything?
I don't think it changes anything for this meeting,
right.
But certainly it creates additional uncertainty and risks. Right? If you think about the distribution of risks, there's a fat tail on the downside. Right? There's more things that can go wrong for the global economy, for the U.S. economy, than can go right at this moment. And this is just one more factor for them to monitor. Doesn't mean they should change their modal forecasts, but it does mean they should continue to remain sensitive and in tune to challenges.
Do you think a lot more can go? Do you think there's a lot more downside right now than upside?
So the center of
the economy, or by the way, or also the markets too.
The center of strength in the U.S. economy has been the consumer, and higher oil prices are a headwind for the consumer. Now, the consumer has proven to be extraordinarily resilient to date, and maybe we'll continue to see that happen. But as Michelle's saying, it's another risk, and it's a risk to really a core part of where the expansion continues.
And think about what the Fed is trying to do. It's insurance cuts, right? They're trying to get ahead of these risks. So they're very carefully thinking about what these risks look like.